Well, I think we're seeing these spikes in volatility in asset markets, as you've seen, and this means that we're in a fairly volatile environment, and maybe investors need to really be quite active in looking at their portfolios and in managing things from a tactical point of view. At the moment, for example, we are seeing signs that risk appetite is starting to recover. The equity outflow globally into mutual funds was half what it was in June compared to May, and we've seen some pretty good inflows into the likes of emerging markets and emerging market bonds. So from that point of view, risk appetite seems to be improving a bit, and there must be a lot of bad news already discounted. So I think short term we could see something of a recovery in markets, which to my mind look oversold on a short term basis. Well, we would say that the Asian markets have been probably punished unfairly by this global loss of investor risk appetite, by this global fright, if you like, because the Asian markets have demonstrated a degree of economic uncoupling, which a lot of people would have thought was not possible, say, 12, 18 months ago, and they have stood up to the sluggish growth in the G7 OECD economies much better than expected, led, of course, by the likes of China, India, Indonesia. And valuations are looking relatively attractive, and the earnings are coming through. So I would be hopeful that when investors come to look at their portfolios for the rest of the year, they will allocate more money at the margin to the emerging markets, because that, after all, is where the growth is. That's a good question. I think we are starting to see that already, in that retail sales have held up very well in China, and consumption has been a stronger driver of growth over the last 12 months. These trends are likely to continue, but it is a multi-year, of course. When China introduces policies to improve the social safety net, to improve pensions and so on, in order to persuade households to save less, it took 10 years for the consumption income ratio to fall. I think we can safely expect it'll take something like that to build it back to 65% again. Well, to us, it's a fairly simple issue. Core portfolios in an Asian equity portfolio should focus on the major economies which have a strong domestic sector. And we've seen that now, not just from China, but we've seen it very much so in India, which also is less dependent on exports to the OECD, which also has its own domestic growth drivers, and which seems to have upped its game and should be capable of 8% GDP growth over the medium term. And our Indian fund manager team believe that earnings per share have the capacity to maybe double over the next 3 to 4 years. So India would be a core position. I know there's some problems that inflation has begun to arise there, and the Reserve Bank of India have been tightening monetary policy at the margin, but those are symptoms of success to my mind rather than failure, and should not put investors off from taking core positions in India. Also, Indonesia is a very interesting Asian economy. That's also got the scale, it's also got the domestic demand components. It is also less correlated with the MSCI World Index and with the global business cycle. Right, okay. First and foremost, we are overweight China, and we believe this is the point where investors should be increasing their commitment, increasing their overweights. We believe that we're not far off from the point where the Beijing authorities stop their selective tightening. We are also overweight India. We are overweight Thailand in ASEAN. We are overweight Indonesia. We would be underweight currently Japan, underweight Malaysia, underweight Philippines, broadly neutral Korea.